Welcome to Talk Tickers. Today we are diving into a really wild earnings report from WillScot Mobile Mini. This thing sent the stock on an absolute roller coaster, and we're going to break down exactly what happened.
So let's just jump right in with the number that really defined the quarter for investors. A brutal 12.1% stock drop over just 2 days following their Q3 announcement. I mean, that is a massive reaction on huge volume. So the big question is, what on earth spooked the market so badly?
While it wasn't just one single thing, the sell-off really started with a set of headline numbers that frankly told a very mixed and pretty confusing story to investors.
So check this out. WSC actually posted a slight beat on adjusted earnings per share. They came in at 30 cents when the street was expecting 29. But that little win, it was completely, and I mean completely overshadowed by the top line. They missed on revenue by nearly 3%, with sales falling almost 6% year over year, and that miss is what grabbed all the negative headlines. Okay, but this is where the story gets a lot more complex. You see, that headline revenue figure was hiding a much more stable reality underneath, and as management was quick to point out, this wasn't just a simple case of demand falling off a cliff. On the earnings call, management dropped a bombshell. There was a massive one-time event, a $25 million hit to their leasing revenue. This came from something they called an accounts receivable cleanup. Think of it like this. They were doing some spring cleaning on their books and decided to write off a whole bunch of old, uncollected bills. That directly torpedoed the reported revenue and made that headline number look way worse than it really was.
And you could tell the CFO really wanted to hammer this point home. His message was crystal clear. If you just strip out this one-time cleanup, our core business was actually stable. The subtext here is, hey, don't judge the health of our company by that ugly headline number you saw.
So, facing these weak results and some pretty obvious skepticism from investors, management knew they couldn't just explain the past. They had to announce a major strategic reset. This is what we call a kitchen sink quarter, where they try to get all the bad news out at once to clear the decks for the future.
The new executive chairman, Worthing Jackman, basically drew a line in the sand. He came out and admitted the company had fallen short and promised a big shift. From now on, they'd be taking a much more conservative approach to guidance, specifically to, in his words, minimize the risk of surprising investors ever again.
So what does this new no more surprises strategy actually look like? Well, the centerpiece is this multi-year network optimization plan. It's a classic efficiency move, designed to streamline the whole operation and cut some major costs. All right, step one is all about cleaning house. The plan is to sell off up to $350 million worth of their lower return fleet units. Basically, they're getting rid of the excess stuff that's just sitting around costing them money to store. And of course, if you get rid of a whole bunch of stuff, you don't need as much space to keep it, right? So step two is a direct result of step one. They're planning to cut their real estate footprint by more than 20%. That's a huge operational consolidation. So what's the big payoff for all this work? Well, management believes this whole plan will help them avoid $20 to $30 million in annual cost increases over the next few years. It's a massive move designed to protect their profit margins down the road.
And this right here is the proof in the pudding of that new conservative philosophy. Their Q4 revenue guide of around $545 million came in way below what the street was expecting. It's the classic under-promise and over-deliver strategy. They didn't just lower the bar, they dropped it on the floor to make absolutely sure they could step over it next time.
Okay, so the company throws the kitchen sink at the quarter, resets expectations. How did Wall Street actually process all of this? Well, the reaction was really a tale of two cities. It unfolded in two very distinct phases. First, you had the panic. The stock just got crushed over 2 days. It was a total knee-jerk reaction to the headline miss and the guidance cut. But then, a couple of weeks later, the whole narrative pivoted, and it was all thanks to one key analyst who completely reframed the story for the market. On November 21st, Baird upgraded the stock, calling Q3 a watershed quarter. They basically came out and told everyone, hey, stop panicking. This is actually good news. Their argument was that by getting all the bad news out in the open and resetting guidance so low, management had created an investable bottom. In other words, the worst was probably over. And that single report was enough to change the mood completely, sending the stock soaring about 11%. All right, so that's the whirlwind of what happened. But here at Talk Tickers, we're all about what happens next. So let's get to our take on how this all sets up the story for the next earnings call.
What's really fascinating now is how clearly the battle lines are drawn on this stock. On one side, you have the bulls. They see a classic turnaround story. They're pointing to strong cash flow, the potential of this new plan, and a super low bar that should be easy to clear. But on the other side, the bears are pumping the brakes. They're worried about the execution risk, the tough macro environment, and the fact that this is now a total show-me story. Management has to earn back trust. So where do we land for the next call? We predict WillScot will meet or probably just nudge past its new lowered Q4 targets. I mean, that's the whole point of the reset, right? Because of that, we see the stock staying pretty choppy, likely range-bound, as the market just waits for proof that this plan is working. For that reason, our rating is market perform. The narrative is reset, but the big question remains, can they deliver? The next call is going to be the first real test.
And a final reminder, this is not financial advice.